it eliminates 100% of any remaining interest. So if your payment's not covering the interest, it used to eliminate 50% of what you weren't paying on the
Mm.
repay plan. Now it's 100% because
Everyone going for PSLF that's married to a spouse that earns income is super complicated.
it throws another decision point into there, right? Of
Funny how anytime these changes come about, they're like sold as simplification, but they seem to complicate things for a lot of people. That's just the nature. I mean, I consider that opportunity because we can be strategic and help you kind of like work around things. But it is much more complicated when you have that added consideration of filing separately versus not.
absolutely, because then you got to go with the filing cost. Usually costs
Mhm.
more to file separate versus the savings potential, and
Yep.
gets really fun. That's
And
why it's a
then what if you're
beautiful
in a
puzzle.
community property states and, because its
If you,
taxes
yeah,
work differently if you file separately and
if you're in a
it,
community property state, either get deep into the blogs on student loan planning out there, or
or
get
pay someone.
or talk to a consultant, because there are so many opportunities there,
Yes.
yeah, to save money if you're going for
You
PSLF.
can hire Jeff and pay him. He will work you around all these rules and whatnot. And I mean, especially in that case, like you said, it's worthwhile to, I think, pay for advice. Okay, so that's the new save plan.
Yeah. One other big benefit there is it eliminates 100% of any remaining interest. So if your payment's not covering the interest, it used to eliminate 50% of what you weren't paying on the
Mm.
repay plan. Now it's 100%. So if you're not covering the interest,
Used to do that on subsidized loans for repay.
yeah, there was some nuance there, right? Where it was for several years on a certain
Yeah, it was.
portion, it would
Now it's
cover it.
100% on all the loans for indefinite.
Yeah, both subsidized and unsubsidized, it covers 100% of any remaining interest. So for those that we have here that maybe are going into this payment resumption with a $0 payment, or coming out of school, or don't have your plan settled quite yet, coming, finishing residency and maybe not quite sure what that first job looks like, or you're ready to get into that first job, this save plan is
Pretty appealing.
likely a good option,
Yep.
unless you're expecting a huge jump in income when you want to go to that pay plan, because you're
Right.
basically getting an interest-free loan for another year.
Yeah. Yeah, it used to be. I mean, we did this back in the day. I guess it's been 10 years almost since or even more than that, since we were talking PSLF with people. But early on that, like the difference between rate repayee and payee, it was all about this payment cap and the interest subsidy part of the repay equation. Basically, and it was probably skewed towards repayee. Like the majority of people probably should get would repay in training, but like maybe 25% would go with payee in training. But now that's just swinging the pendulum further towards this repayee slash save sort of route where I don't know, the majority, probably 80% or more, 90% maybe of people in training should go with this plan over payee. And I guess payee is going to go away anyway. And this is going to be the only option.
This will basically be the only option.
Are the old options going to still there?
So they're
They need
all the
goodness.
synonym sounding things, like the overall thing we have to have here is an income driven plan, IDR, but that's
Yeah.
not a plan itself, right? So you've got income contingent repayment, that's going
Yeah.
away. Sounded a lot like income driven, but it was income contingent, right? Income based repayment, the old version is gone, but the new version still remains. So that may still be an option to look at coming out of school or out of residency in the
New
future.
IBR is staying put.
New income based repayment. That's what, and if you don't know what new is, it's just,
Yeah,
it's still available. We'll put it that way. It's a lot like pay as you earn for
yep.
brand new borrowers. So that has a limit of, if you've made more than 60 payments on this new plan, you can't go back to it, but it'll still be available. So,
Yep.
but then for the vast majority, and this is what we're seeing as we look at the loan balances, the payment options, the save plan is going to be the best option for, I would say, 80 to 85% of the individuals we've looked at so far,
Yep.
because it is generous and the payments are lower until you hit that cap.
So
Hopefully
generally
that,
speaking, this is a win.
generally speaking, a win, unless you got a
I mean, you
low,
do have to make payments,
yes,
but
low balance for the loan,
l-
or high income, very high income to that loan balance would be the two things to keep an eye on.